Coming up in today's episode, stocks finish lower as private companies add almost 500,000 jobs, more than double expectations. The Fed's almost certain to raise rates in a couple of weeks. Meta launches Threads to challenge Twitter. Elon Musk fires back with a legal threat. JP Morgan says the UK could see a hard landing. We get another warning from another billionaire. Global funding plunges 49%. And China scrambles to support its plunging currency. Welcome back to Click Capital, everybody. My name's Jared, and I hope you're having a great week so far. And if you haven't already, hit that subscribe button. And these daily market analysis videos will show up on your YouTube homepage screen every time you log in, as I make them every day after market close to let you know all the most important events out there and what's really going on in the market. And so there was a bit of a bearish breadth out there today. Across the board, it was really just the two biggest stocks in the market, Apple and Microsoft, that looked like the spots where investors sought safety. And we continue to see more weakness in the semis, and energy stocks came off a bit as well. And that's largely thanks to the report we got from ADP, which measures the payrolls of 29 million private sector jobs. And so the market was expecting that to come in at 220,000 new jobs. Actually came in more than double, almost 500,000 new jobs. However, this is one of the least reliable indicators of the jobs market and is a lot more volatile than the bigger ones we pay attention to, like weekly initial jobless claims and the non-farm payroll report, which we'll be getting tomorrow. However, nonetheless, it does show there is still some strength in the jobs market. It is holding up, but once again, another bit of mixed data for us to try and get our heads around. So on the back of that ADP report, today the market is expecting the big one, non-farms payrolls, to come in hot tomorrow. They're expecting 240,000 new jobs would have been created in June, and that'll bring the unemployment rate a touch lower to 3.6%. And that's down from the 330,000 jobs that were created in May. And we also had the initial weekly jobless claims out today, which actually came in a touch higher than expected. And again, with more mixed data, was the JOLTS job openings, which came in a little less than expected as well. So that shows the amount of jobs that were open for positions. But of course, it was that ADP number that came in a lot higher. That has nearly convinced the market that the Fed will hike later on this month on July 26. And we've also got the market pricing in a 25% chance they'll hike again in September. Then the Fed skips a meeting in October and meets again at the start of November, and the market's even got a small 7.3% chance they'll do a third hike by then. Which, in my opinion, the stock market is not pricing in at all. The stock market kind of seems convinced there's only one more hike left in the bag. And historically speaking, the Fed will keep hiking rates until something breaks. And like this article says here, there weren't any signs of dovishness from the Fed meeting minutes. And these higher rates will eventually have to have an effect on US economic growth, as their number one mandate is to get inflation back down to 2%. And kind of the only way to do that is to throw a wet blanket on the economy and the jobs market. And it's for that reason and a few others why we've still got billionaires like Jeremy Grantham, who is an avid student of the markets and especially in crashes and bubbles, says the stock market has a 70% chance of crashing, and he even thinks it could be an epic burst like the 1929 crisis. And he's not just some pundit you see on the news, he's actually co-founder of the investment company GMO, which handles near 65 billion in assets. He's worth $1 billion himself, and he's convinced the market has created a perfect storm for bubbles such as asset prices, but he said the emergence of artificial intelligence has delayed the pop. He goes on to say, I'm only interested in the really great bubbles like 29, 2000, 21, which he thinks are the three senior bubbles in the US stock market. We have checked off pretty well every one of the boxes. And he said those boxes are periods of long economic upswings, a strong bull market, and strong earnings. And he said in each of those scenarios, the markets were then followed by a sharp leg down. He also calls AI a mini bubble, and he thinks the AI rally is a niche market. He goes on to say, Lord knows this was complicated before AI raised its ugly head. We had inflation, the Fed, how quickly would rates go up, how far they would go up, how would the war play out? It goes on. And he said, since ChatGPT came out in November last year, we have a new little flurry of interest that is very concentrated. Some other strategists are saying stocks could crash 25% with the Fed rate hike set to trigger a recession before the end of this year. That's according to FS Investments, who said stocks would crater if the Fed keeps carrying on raising rates. And then the economy will soon be one of the biggest threats to equity prices. And we're already seeing the effects of those higher rates in the global funding market, where companies are looking for finance from private equity, venture capitalists, and the like. Even with the AI hype, global funding did fall 49% in Q2 compared to the year earlier. And it's also down for the first half of the year. So there was 144 billion in funding. That was down from 293 billion in the first 6 months of 2022. And out of that 144 billion, 25 of it was in AI related investments, with The biggest being Microsoft's $10 billion injection into OpenAI. And the reason why we're seeing that funding coming down is because the days of that easy money where the cost of capital was near zero are over. And that's when these big investors only needed a small 2-3% return to make a good profit. And like we can see in the chart here of the US government bond 2-year yield actually got up to 5.11% today. And that's the highest we've been just before the global financial crisis back in early 2007. And so basically when your cost of capital is 5%, or you can earn a guaranteed 5% from the US government, the safest third party in the world, then for you to invest in a company and take on that risk, you're going to need a premium above that, a margin of safety to compensate for your risk in that. So the returns that investments must deliver to investors now, the bar's set a lot higher for that. And that's why we're seeing funding come off. However, there's always two sides to the coin, and we've still got a lot of bulls out there. With Bank of America saying that stocks are on track to push the SP500 to 5,000 within the next 6 months to start off next year. They compared the current bull market that began in 2013 to secular bull markets in the 50s and 80s. They went on to say the presidential cycle should serve as a tailwind for stocks. And they also pointed out that MACD is about to go positive on the monthly chart. Sharing that sentiment is the biggest bull on the street, Fundstrap Tom Lee, who says the new bull market will be driven by AI advancements and the Fed's successful efforts in curbing inflation. And he's actually got a target for the end of the year of 48.25 on the S&P. He said the market bottomed in October last year and we're at the start of a new bull market. Another news out today, we've got Mark Zuckerberg's Meta launching the Instagram Threads in a direct challenge to Twitter. And just another classic move from the Zuck. His whole business model is based off copying others and what's working out there. It's kind of sad in my opinion, if you ask me. And of course, Elon's just not one to sit there and take it. He actually accused them of cheating and had his lawyer send a cease and desist letter straight to Mark Zuckerberg himself and confirmed that on Twitter not too long ago by saying competition is fine, cheating is not. That's because Elon made Twitter's source code and IP public and open source in the pursuit of transparency and trying to turn Twitter into a true free speech platform that isn't tilted politically to one side. Unlike Meta and Mark Zuckerberg, who makes really large political donations, along with strong evidence of political censoring in the content on his platforms. And so not only are these two guys fighting it out online in social media, hopefully we'll see them both in the cage as well. We've also got JP Morgan warning the United Kingdom could see a hard landing if interest rates hit 7%. So they expect them to peak at 5.75 by November, a similar rate to what the US market's kind of expecting their rates to peak at. However, like some are starting to say, they could go higher and up to 7%. And that's really what's going to tip the stock market over, is it's kind of a foregone conclusion that rates are at the end of the cycle. Even though the Fed is not making any indication of that, at best they're saying we're just going to hold rates really high for really long. And people just look back to the past cycles where the Feds pause, we get a little bit of economic weakness, then they cut. But you got to remember, we've had the highest, most sticky inflation in over 40 years around the world, as all that central bank stimulus and low rates has actually resulted in structural inflation. And that's why we've still got those high CPIs around the world, especially in the UK, higher than America, with CPIs around 8-9%, and still well above the 2% targets that most central banks want to get down to. So like I showed on the chart before, if you can get a risk-free 7%, why would you invest in stocks with decreasing earnings if they've got an earnings yield of 4-5%? Same goes with property. All the hassle and risk of managing tenants for a 4-5% yield. If we see rates at 7%, you're going to see a lot of big money going into those risk-free bonds. And China's still working to plug their slowing economy, and we can see that in the depreciating value of the yuan. So typically the strength of a country's currency is correlated with the strength of its economy, or what traders are forecasting for the economy. And we've now got the Chinese yuan getting down towards a 14-year low, as they've still got a lot of big problems in their real estate market, the COVID opening bump pulling back, and of course the West still deleveraging from the Chinese economy. However, like we've been saying now, the stock market has been strongly ignoring all of that for a while, with the fear and greed index still stuck in the extreme greed zone. A little busier on the options market today. 37.5 million contracts traded, 55% of them calls. And once again, we're seeing that strange put activity in the high yield corporate bond ETF. 88% of the volume today was in puts. And since high yield corporate bonds have been holding up pretty well, just like stocks, I'm just wondering if there's some big portfolios or funds just loading into downside protection in the high yield bond space. Not too much insights to be drawn from dark pool traders, with the DIX index bouncing around, coming back down today to 49%. Although we did see a bump up in the selling activity of corporate insiders. That's the executives and people on the board of directors selling their own stock yesterday, with 198 sales reported versus 6 purchases. Okay, back into the charts. And so we were off across the board today in all the main American indices. We got the SP 500 at 44.11. Now let's take you down to a 15-minute chart. So we gapped down and we sold off to about 11 a.m. Then we popped back up, and that's what created that hammer formation on the daily chart. And we can see that across the board in all indices. Really narrow range there on the Qs. Equal weight Qs actually came off a bit, and mids, smalls, and micro caps was the loser back below its 50. And there's a look at our sector trends table indicator, and we can see now quite a lot of red up the front, with most sectors underneath their 5-bar moving average, all except communications, real estate, utilities, and staples, and almost half of all sectors below their 20-day moving average as well. But most of them still holding on to their 50s. So we just got a bit of weakness right in the immediate time frame here. Got a lot more weakness in the international stock indices versus the American ones. Here's Canada's TSX back below its 50-day VWAP. UK's FTSE sold off really hard overnight, finding multi-month lows, getting down to oversold territory. Similar story with the German DAX, seems to have turned down sharply here. Japan's Nikkei turning down a little bit more softly, and look at that big move down in the Aussie 200, and the China 50 index still weak in a downtrend as well. And look at this, looks like volatility may be starting to wake up a bit here. We got the VIX 9-day climbing 11% today, but opposite to the market's price action, we did an inverted hammer on the VIX as we bounced back after lunchtime. But nonetheless, that is the biggest move up in the VIX we've seen in a little while now, popping up to 15.3. We did get up to 17 today. And same with the volatility of volatility index VVIX, and volatility risk premium increasing as well. Option dealers may be saying there's some moves coming up ahead. And look at the spread of the move versus the VIX. So the move index is the bond equivalent of the VIX. Shows you how much bond prices are moving around. And typically the bond market is better at forecasting upcoming economic activity than the stock market. And so we can see now the volatility in bonds versus the volatility in stocks is just about as elevated as it's ever been. In fact, the only time we've been higher in mid-2008, going into that big crash we had in the stock market in the fourth quarter of 2008 at the height of the global financial crisis. And that's when the volatility in stocks eclipsed the volatility in bonds. And similar story in the skew index as well, getting elevated at 148. We're only really higher back in mid-late 2021. And this is another sign the market could be pricing in an upcoming correction or crash. We had short-term breadth pull back sharply today. The amount of stocks above their 20-day average fell 21% to 61. We still have the majority of stocks above their long-term average at 60. And stocks making new lows today eclipsed stocks making new highs on the NYSE 18 to 15. And the Nasdaq 48 to 15. Bit of bearish breadth out there today, but that didn't knock over the growth sectors versus the defensive sectors. And that's because we saw Microsoft and Apple, which are large weightings in the growth sectors, holding up pretty well. But overall, high beta stocks did come off a bit versus their low volatility counterparts. And there's small caps struggling to find a bottom versus large caps. So with mega cap tech dominating the S&P 500, most stocks as measured by the Russell 2000, which is much more evenly distributed index in terms of weightings, is still weak. There's international developed stocks finding another multi-month low versus the SP500. Same with European stocks getting really whacked down hard today. And there's a look at inflation expectations as measured by the inflation protected treasuries versus regular treasuries. Spread on this chart just broke out to a multi-month high today. And the same with the price action in the 2-year and the 10-year. The market may be ramping up its expectations on inflations again, and definitely on future Fed hikes. So with those higher rates, bond prices come down, and that's why we've got the TLT ETF back down into the support zone. And high yields actually fell a bit today, coming back down to support as well. High yields are normally good for a country's currency. However, we didn't see the dollar move up too much today, kind of just hanging around its 50 here. And look at Bitcoin. This is kind of a hard one to decipher. We did whip up to 31,500 in today's session. However, that was rejected and sold back pretty quick. We now have this divergence on the DSI. However, the hidden divergence indicator is still holding in there, and we're kind of just consolidating in this zone here. And I'd say the market's kind of waiting to see if the SEC is going to approve those applications from BlackRock, Fidelity, and the like, whether they can open their spot Bitcoin ETFs. If the SEC does approve them, then we're going to see a big rush of institutional money into the ETF, which will then have to go and buy Bitcoin in the spot market, and that should cause Bitcoin to break out. However, if those were rejected, then we should see it pull back quite sharply. Commodity market still tracking sideways, with crude breaking back above its 50-day VWAP, and we're starting to see a little bit of short-term strength here, and crude may have found a bottom. Over to stock sectors, and red across the board, not a single green sector out there today. Even the defensive sectors like utilities was off 1.2%. Bit of weakness in the highly valued stuff, with ARC off 3.8%, clean energy off 3.5%, and a bit of a pullback in the Jets ETF after we we had a great run up this last month. As a look at the BlackRock barometer sitting right at its 50. JP Morgan pulled back but was dip bought. Tesla came off a little bit in a narrow range. NVDA still holding up there, and the winners today were Apple and Microsoft. Looks like a lot of people sought refuge in the big guys. Bit of weakness across the meme space, and not a whole lot of standout stocks out there today. We got Q2 earnings season starting next week, so things will start ramping up then. And still got a little bit of weakness in the regional banks, kind of tracking sideways. And there's a look at our SP 500 oscillator, which kind of measures sentiment in the market. It looks at technicals and fundamentals, market internals, option volatility data, retail sentiment, and that fell sharply today. So we had been in these stubbornly overbought levels for over a month, which was pretty unusual in itself. And it was just a couple of sessions ago we were overbought at 63, and now we fell sharply today down to 48, and that can be a sign of a potential upcoming move direction in the market, like we saw in the volatility market as well today. And just taking you back to some other similar sharp 3-day moves, in our indicator was back here in August. We went from a similar overbought level, then fell sharply on this day here down into the mid 40s on the oscillator, and that preempted an 800-point move down in the S&P 500. A little bit of a similar story. Back in April, we fell down to the mid-high 40s a little bit quickly, and before we sold off a bit. Other times, our S&P 500 oscillator dived quickly. It was actually back in late January. Dived really hard, back down to oversold levels really quickly, and the market only peaked a couple of weeks later before, of course, we got that big COVID dive. Another similar setup was in September 2018. You can see here, market just pulled back a little bit, but look at our S&P 500 oscillator, absolutely dived, and that too preempted a bit of a sharp move down in the market. Similar story in the Volmageddon scenario in early 2018. S&P 500 oscillator dived pretty sharply, and that too preluded a pretty sharp move down. So even though the market just came off a little bit today, I mean the S&P 500 didn't even fall 1%. The S&P 500 oscillator that we've developed could be warning us that something big may be around the corner. And remember, the market has been really bullish this last month. We've had sentiment readings across the board reaching near record levels. And of course, the options market just loading up on calls like late 2021. So the market is still primed for a pretty good rug pull here. And just like the 5-day moving average on the put call ratio, as shown in this yellow line here at 0.73, just shows the market is not hedged for it. And with the skew index at 148, meaning out of the money put prices are already elevated, anybody that's not already hedged will be paying through the nose for those hedges when the market does come off. And just a look at the global net liquidity fair value model, which kind of adds up all the liquidity from the major central banks around the world and turns it into a fair value price for the S&P 500. That's at its record widest gap right now at 35.38, almost 900 point gap between the S&P 500. And so this is the biggest divergence we've seen the stock market have from global liquidity ever since this model kind of kicked in after COVID. And you can see the price kind of always comes back to the model. The only other really big gap we had was back in August last year when the S&P got up to 43 and the fair value was at 38. So that was only a 500 point gap, and the S&P did finally catch up to that model. So if this model's still right and the market is still being driven by global liquidity in the system, then this is setting up for potentially an epic correction that could be like early 2018. And let me just show you the price action in that period. So, and some of you may remember in mid-late 2017, we were just on this parabolic uprise in the S&P 500. The VIX was super low, and a really popular trading strategy back here was shorting volatility, and there was a lot of short volatility ETFs. And people just loaded into that like they found the new paradigm. It's easy money, it's free money, just sell volatility in the market. And it was such a popular thing until late January in 2018. When it all fell apart really quickly. And unfortunately, that blew up a lot of traders and funds who were short volatility, and they called that period of time Volmageddon. So a similar setup and price action in the NASDAQ here, and we've got volatility really low. And so potentially we could be setting up for a Volmageddon 2.0 scenario. And that's something I'm very mindful of, and that's why I'm staying market neutral. And that pretty much wraps it up for today. Thanks very much for sticking with me. Appreciate your support of this channel by clicking that like button. And I hope to see you again tomorrow afternoon as I'll be diving into the big one, the non-farm payrolls and unemployment rate. And we'll see what the end of the week brings us. All right, guys, see you then.